very bright. So welcome back, everybody, after lunch, which is the best slot always. Everybody's happy, relaxed again. So now, after we heard so much about hyperinflation in a general context and as well in a current day context of emerging markets in Argentina, we're going to give the format a bit more of a discussion format. So we're going to talk to central bankers that actually lived through episodes of hyperinflation. So we're going to hear from Charles Goodhart, who was governor or an advisor to the governor of the Bank of England for a very long time, I think for almost 20 years. Is that correct? Correct me if I'm wrong. Then we have Mr. Pavel, help me with your last name. I have asked you 3 times already. Exactly. From the National Bank of Poland. We have Mr. Ninovsky from the Central Bank of Bulgaria. And we have Mr. Sapari, who is an advisor to the Central Bank of Hungary for a very long time. So the panel is going to be moderated by Hugo. For 1 hour, we're going to discuss, and all of your questions will be very welcome.
Good. Thank you, Carmen. We start, as we started the other panels, with introductory comments by the panel members. Then I have a couple of icebreaker questions if needed, but I would also be very happy to take you the lead and use the question and answer in as much as you want. So the theme today for this panel is how do central banks deal with the subject of hyperinflation? None of us on the panel has really experienced hyperinflation whilst they were in office. But nevertheless, it's a topic that is researched, studied and followed in all central banks because it could happen again, and we know it happens in other places of the world. So we thought rather than talking about hyperinflation itself, we are going to talk how do central banks deal with the subject of hyperinflation and what do they do in order to understand the phenomenon properly. So the first person who's going to talk will be Charles Goodhart. Then we follow with Pavel. Then it will be Nikolai. And Georgi will make the final comments. And then we start with the question and answers. And with this, and without further ado, Charles, please.
Thank you very much, Hugo. I feel rather an imposter at this wonderful conference. To begin with, I don't have any PowerPoints to show you. I did have some, but they were rather general comments about hyperinflation. And I thought correctly that everything that I had on my PowerPoint would actually already have been said, and I didn't want just to repeat it. Second reason why I'm a bit imposter is it talks about experiences with hyperinflation in the 1990s. And we in the UK had absolutely no experience of hyperinflation in the 1990s. Rather, it was the beginning of the Great Moderation. So it was a very sort of pleasant time in central banking. So what I'm actually going to talk about is my experience in the 1970s when I was a chief monetary economist in the Bank of England throughout that period, which was the most inflationary decade I think we've ever had. At one point, inflation at an annual rate reached 25%, and the yield on one of our long bonds came to be exactly equal to the price. They were both at about 18. And there were 3 sort of lessons that I learned from my experience at that time. The first one was that the worst aspect that we had was that the Prime Minister, Ted Heath, had mistakenly provided indexation of wages in advance of the great energy price increase in 1973, which went up by 4 times, a much greater supply shock than was actually introduced by the Ukraine war. So the first lesson I learned was don't index incomes, whatever you do. And I was actually quite surprised that this morning there was never any mention of indexation that I heard from any of the speakers at all, and the dangers of indexation. Second lesson that I learned was that if there is a supply shock, an adverse terms of trade shock, you want to move very, very quickly to counter it, because otherwise you're quite likely to run into the development of a wage price spiral which will be generated. In particularly, Germany and the Deutsche Bundesbank reacted to the problems in 73, 74 much quicker and much more effectively than the Bank of England did. Incidentally, there's all been a lot of talk about memory. The experience that I have is that memories are extremely short. For example, I said that you shouldn't index. What the Conservatives did during the last few years has been to index pensions. And that meant that there was much more pressure on other parts of the economy, and particularly public sector wages, where they had an ability to control. So they had to bear down on public sector wages much more heavily than they otherwise would have done. And that has led to the kind of strikes and discombobulation of the British system, nurses, doctors, people we would never have expected to go on strike in advance. And again, despite the lessons of 73, the 70s, that if there's a supply shock, move quickly, there was all this stuff about it's only transitory, we should look through it. And the central banks are accused as a generality of having moved too slow. So we didn't learn the lesson of the 1970s. The next point that I would make is that the experience of the 1970s emphasized, at any rate to me, the overwhelming importance in many circumstances of the interaction between fiscal and monetary policies. One of the developments of the years between about 1992 perhaps, or 1993, and 2020, is that the importance of the interaction between fiscal and monetary policies, particularly on the monetary side, got very much downgraded and de-emphasized. Remember that this was a period in which, as a generality, the rate of growth of the economy, G, was greater than the interest rate. G was greater than R. And for many of these years, particularly after the great financial crisis after 2008, R was incredibly low. That meant that the kind of models which central bankers tended to use, the kind of Woodford 3 equation model, didn't include fiscal policy at all. You could, as a central banker, aim for what you thought was the optimal path of interest rates without really taking fiscal policy into control or simply taking it as a given, and you didn't have to worry too much about the interaction. What I have to tell you is that those days are past. They're gone, and the future is going to be exceedingly difficult from what has been the behavior of central banks in the advanced economies in recent years. Let me go back to the 1970s just for a short time. That was a period of monetarism. We were trying to achieve monetary targets. We had DCE targets given us by the IMF, and then we had the conservative monetary target. And for a variety of reasons that I won't go into now, but I could at great length, we tried to achieve our monetary targets in some considerable sense by adjusting the debt sales, public sector debt sales, in such a way as to achieve the monetary targets. What we soon realized was that the worst thing for debt sales is a slow, steady, expected increase in interest rates. No one will buy your debt under those circumstances. If you have to raise interest rates, do it quickly, do it in a large jump, and then have a period of slow, gentle decline in interest rates so you can maximize debt sales. And that's the world in which we're going to live. Again, virtually nobody has mentioned the massive increase in debt ratios everywhere, the very large increase continuing in deficits, The fiscal situation in virtually all our countries, not excluding the US, in fact including them almost particularly, has become what the CBO and the IMF and everybody else has said as unsustainable. If the debt position, the fiscal debt position is unsustainable, then what are you going to do? What you're going to have to do is manage monetary policy in such a way as to make the debt system manageable. And one of the dangers here is that if it goes too far, then the pressures will be on you as central banks, effectively to monetize the debt, to go back to QE on a large basis, and to increase the money supply, and that could lead you back towards hyperinflation. And the interaction between monetary policy and debt management in a world of massively high debt ratios and unsustainable deficits is something that, unless politically we can get the fiscal position under control, is going to be a significant and major problem for all of you.
Thank you, Charles. Shall we just continue with, we wait with the question to the very end, so please take notes. Pavel, can I give the word to you?
Yes, thank you. Yeah, before lunch we've heard a few observations about the Polish experience 100 years ago, and I'm happy to share, to jump into the times where I lived, although I was not a policymaker at the time, definitely not, in the early 90s and late 80s. Before the inflation in Poland accelerated already in the second half of the 80s, and in short, the reason was, and it's a recurring topic here, lost governability, broken credibility of the political and economical system. That is, the Communist Party, which was in charge at the time of the country, tried to experiment with more refined, more efficient version of socialism, looking at the experience of Hungarian comrades or Yugoslav comrades, and take some of the cherries from the cake. So they gave a large degree of autonomy to the state-owned enterprises, already in 82. That is, they were able to set out their own prices and contract on the market. And the state-owned enterprises reacted in the simplest possible way, by using this freedom to increase prices. The price mechanism was fragmented. That is, there divided prices into three categories: the fixed ones for like electricity and basic foodstuffs, then the free ones or so-called contractual prices, and the middle field in between, the ones which were under the guidance of the government. So the entire effort of the operators was to game the system of trying to get everything from this myriad of regulations. And what happened was also the wage price spiral, fueled by chronic shortage of goods as well, because this is one element of the socialist or central planned economy, which was well remembered. So already in the second half of the 80s, on the macro level, in theory, the system was, there was central planning. The government adopted the central plans, and it gave up any instruments to enforce these targets of the plans on their own assets. So it was pretty much dysfunctional. And combined with the political fragmentation, it led to a phenomenon of accelerated inflation. And in December 87, it was 31%, still very low, moderate. A year later, 88, 73. And in 89, it accelerated and exploded effectively. And there's a combination of the factors. First, there was this political breakthrough. That is the contractual agreement about sharing power between the then Solidarity Trade Union and the communist government in place. And the great victory for the trade unions, which was, yes, indexation. It is the summer of 89. And then the last socialist or communist government in summer of the same year decided to free the prices of foodstuffs just before resigning, just before going, leaving the scene. So what comes obviously is there's a price shock, and everyone learns how to behave in the new environment. There comes political change, and January 1st, 1990, where the shock therapy takes place, where the shock therapy is implemented. Simultaneously, before this happened, as a part of the reform package, the central bank received a certain degree of autonomy. Not yet full independence, but a certain degree of autonomy, which means it was no longer like the Treasury Department of the government, but it had its own say in the politics, but not fully. And so after the prices were freed, in February 1990, there was this huge, the peak. It was moderate when we compare it to Zimbabwe or Hungary or Germany, because it was only 1,180% on an annual basis, and it then began to decelerate quickly. There is a variety of measures introduced to combat that. First, in order to break the wage spiral, there was excessive taxation on the increase of the wages in the state-owned companies. So the government tried to take back what it conceded a few months earlier. And it was, the unions obviously were protesting because it was discriminatory, because it applied only to state-owned enterprises. All other measures, budget deficit was put into manageable shape. The budget discipline became the predominant theme of the day. Reduction of tariffs and import duties. So there's the expectation was that the importation of the goods would drive the domestic pressures down and would counter the behavior of the domestic producers. Even credit limits as granted by individual banks, also increase of the main bank rate, but that did not play much role, to be fair, because also the market was not very developed. The signal did not transmit it into a real behavior. The institutional setting, as I said, was quite complex, and it was not crystal clear, to be fair, but it sort of worked, meaning the bank drafted the on an annual basis the draft monetary policy, but it was finally approved by the parliament, by the House, which from time to time changes that document because it thought that better performance, better targets are to be achieved. The main parameter used in this document was not the inflation target, which we know operate. What I know was the money supply aggregate. It was the main parameter, and for many years, actual performance was much higher than what was provided in the document, which are obvious questions of credibility and actually questions of who's responsible and who's running the show. Then there was the other field of tension, that is the inflation target as such was again set by the government itself on an annual basis in the country's budget, and the bank was supposed to deliver on that. The problem is that the government sort of cheated on that because they wanted to get the inflation rent, obviously. So they projected lower inflation that the well-sounded forecast would provide, because the outlays of the government were fixed, and they enjoyed higher revenues. Eventually, the producing better result when it comes to managing the deficit. But again, the questions by the public were addressed to the bank, and we were sort of asked or blamed for that. Then there was this currency regime, also established by the Council of Ministers. And initially, Poland, as one of the measures to anchor inflation expectation, decided to go into fixed exchange rate against the dollar at 9,500. I think the majority of the population still remembers that. And 9,500 zloty on the 1st of January. And in contrast to what happened in the year of 1924, which was mentioned before lunch, the initially zloty was undervalued because Mr. Balcerowicz and others who implemented the measures, they studied very exactly what went wrong and what worked in the 20s. So they provided for the buffer for eventual devaluation. But since inflation in Poland was much higher than in our trading partners, it quickly lost this room, this buffer. So the country then moved to the crawling peg regime. That is, the currency was devalued at the predetermined rate announced publicly each month. And that created inflow of the hot capital, hot financial capital, which was not welcomed. Therefore, they moved to the crawling peg within a band of 7% up each way, up or down each way. But as I said, the system, although it was not crystal clear, it worked in practice, sort of, because inflation went down from 3 digits down to 2 digits in January 91, continuing downward trend, but sort of oscillating around 30% for a few months, and only to fall below 20 on an annual basis in 96. In 96. But, yes, in 97, we were the only country from the region which had higher GDP than in 89. So perhaps, after all, it was learning by doing, a little bit of this, a little bit of that, but it sort of worked. One element which should be said. So we're asking ourselves why. What happened? What happened? There was obviously, unlike in the 24, there was some support from our friends. That is the $1 billion stabilization fund for the Polish zloty. You can imagine $1 billion is nothing in today's terms, but you say that it worked. It was never drawn. The country never drawn on these funds. But it was commitment by the advanced economies to support the zloty. So the policy of the fixed exchange rate had some grounds. It was not what we experienced in 24, but a little bit of observation, perhaps discussion. It was not the choice of Grabski, unfortunately. He tried to make the virtue out of necessity, but the country in 24 or 23 had no credit. When they tried to get a credit in London or New York, they said, "Thank you, we might like you, but come later." So Grabski had to mobilize domestic public, we will do it on our own. And then what comes next, 97, and the full independence of the central bank. Full independence of the central bank granted by the constitution of the country. And surprisingly, and it's not still very much researched, and perhaps it might be because some people within a bank are not that eager to do that. First thing which the Monetary Policy Council decided to do, well, not first thing, one of the first things when they said and they took their seats, was to start tightening of the monetary policy very aggressively. With the inflation around 7% in summer 99, they started the hikes. They went up to 19% within a year, acting on some data, some forecast for future inflation. The arguments was trade imbalances, budgetary discipline, and so on and so forth. So they did manage, yes, they did manage to cool down economy and inflation. So it fell below 1% in 2003, with unemployment up to 20%. And that's the end of the story. So what works effectively? What's on the menu? And in 2004, country joined the European Union, and there was a huge wave of immigration to the UK and Ireland. 1 million plus people left. Yep, thank you.
Could we take the rest on then in the discussion? So maybe we just move on to Nikolai. Yeah.
So I have a very small presentation. When you listen Bulgaria, it's currency board, Eurozone, and how we can exit from the currency board. Already was mentioned that the currency board is like a communism. You know how to enter, but you don't know how to exit. So we need to go a big strategy, and we have this strategy join the Eurozone. But first I will speak a little bit about the inflation and the end of 90s. It was a hyperinflation in my view. Okay. So the approximate date of the hyperinflation was in 97 to February of 95 to February 97. There was two periods with very huge inflation. In January there was 243 inflation, and let's say at the annual basis there was almost 600 percentage, but which is very strange that a few months later, in March, we had already 12%, and in, I think in April, we had already deflation. It's a so-called Nogarot miracle, let's say le miracle de Nogarot. He defined in his famous paper on Hungarian hyperinflation. The exchange rate get the same dynamics. I can show you some picture. You can see the hyperinflation, the hyperinflation in March and February, and then the rising of the basic exchange rate of the central bank, which was not effective anyhow because he was less than the inflation. But in any case, it was a huge. I think it was a huge mistake to rise the interest rate and the top of inflation. So the next slide that I like to show the important story of the exchange rate, because the exchange rate we don't speak today, but the exchange rate is a basic variable. It's not inflation, it's not the monetary supply. All causality go from exchange rate to inflation and then to monetary supply. On the short period, you have a very quick reaction, and this is anticipation are concentrated on exchange rate, then they move to price, and then they move to rise of money supply. So you can see the spike of the exchange rate devaluation, and the foreign exchange reserve fall to the very, very low level, or 400 million, not billion, but million. And finally, we have the classical illustration of the Bulgarian inflation, that the real demand decline, real stock of currency in these figures. There's deposits. I should say that there was a huge refinancing from the central bank without the collateral. And the end of the 96, there was a huge injection from the central bank to the budget, which was amounted 7% of the GDP. It was just for one let's say month. The causes. So the causes are common for some hyperinflation. You have a hyperinflation. In this period, there was a huge transformation of economy from plant to market. And then we had this suppressed inflation, monetary overhang. There was a shortage on the good side. And there was a huge disorganization of the economy. There's a special theory of disorganization. And there was also like our Serbian colleague tell today, a huge chronic capitalism, because it's a kind of primitive accumulation of capital, and there was a distribution of wealth, of property right, and all this. So all this finally go to the bank, to the loss of the bank, and then to the budget deficit. Finally, it was monetized by the central bank, and this all is known by the famous Hungarian János Kornai as a soft budget constraint. And Bulgarian case was very high because we had a very huge foreign debt. We have a very huge foreign debt, and the 60% of the budget went to service the debt. So you can see the 60% in this period, so it was enormous, and there was anticipation of default. My scheme, because I started to work in the central bank in this period, I was in charge to calculate the exchange rate, how we can move to the currency board, etc. So I did some research on hyperinflation, and I discovered that the basic variable in Bulgaria in the short period was the exchange rate anticipation, and then this anticipation, they went to prices, and then via the destruction of losses, via the destruction of accumulation of debt, etc., social tensions, it's won to the monetary supply, and then we have this backward causality. So we can see that in the long term, money determine price, and let's say exchange rate is at the end, but when the hyperinflation is here, because this is a more volatile variable, first we start with the exchange rate. So this is a scheme for this period. I did many econometrics in this period, so I determined that the exchange rate is the basic variable, not the monetary supply. Even I test the parameters of Kagan, the famous multiplication of the elasticity of real demand to expected inflation, and the adaptation, the coefficient beta adaptation of, let's say, memory. So I discovered that in this period we had this kind of hyperinflation. So this is about the fact. Now, the solution. The solution could be only institutional and political. When you need a radical economic, monetary, and political change, in this period, we introduced the currency board. There was internal discussion, but there was also advised by International Monetary Fund. But there was also a change, a huge change on the political side. We get our savior, like Grabski in Poland. Our savior's name was Ivan Kostov, and he was from the right party. He came in power immediately after the establishment of the currency board, which is very interesting that the exchange rate stabilized even when we announced on the media that the exchange rate will be fixed in July. In March already there was no inflation, exchange rate was fixed, always good. So, and the 1st of July 97, we start the new institution with absolutely new balance sheet. It means that the balance sheet of the new institution is completely different from the other one. We kept some items, but there was no debt, nothing. So you need to start with the new institution, and you need the foreign loan. Foreign loan came in this case from the IMF. I don't need to explain what is the currency board. You know, this is the fixed exchange rate, full coverage, etc., etc. I like to stress that the Bulgarian currency board is the second generation currency board. We are not so orthodox like colonial currency board, etc. We have a banking department. We have limited lender of last resort, but which is most important, we have the banking regulation very well developed. We have a different buffers. We control the lending, etc., etc. And then we have reserve requirement that help to transmission mechanism with the Eurozone. So this is the second generation. So this is one of the innovation. When we announced that the currency board will be put in July, there was complete consensus, all practically complete consensus on the new regime. You can see creditor, foreign, external, debtor, manager, house code, crony, no crony, because there was not any more debt. The debt was zero, domestic debt was zero, the privatization was over, and now we start the new regime, capitalist economy, privatization, stable budget, etc., etc. So, Professor James today speak about Elias Canetti. I know this book for many times because Canetti is born in Bulgaria, in the north of Bulgaria, and he wrote this famous book about growth and inflation. I forgot exactly the title, but it means that in the hyperinflation, you are the same, poor or rich, you don't have choice. So the result, we have now very low inflation. We accumulated a huge amount of foreign reserve, never had problem with the currency board. It doesn't mean that the currency board is panacea, but it means that it's a consensual institutions. What is the factor that explains why the currency board stays till now? There's two factors. The first one is this consensus. The second factor is geopolitical one, because we are going to join the Eurozone, and we have capital flow from Europe. You have capital founding. And this is a second anchor. For me, there was the first anchor was a currency board, and the second external geopolitical anchor was the European accession. So I think when Bulgaria joined the EU, we start to rise this moral hazard, crony behavior like before. So I think now in this moment, I think that because the Eurozone is not a previous strong, let's say, anchor, I say that the marginal utility now of the currency board is declining, and we need more supporting institution. But the basic factor, already we said that the stable fiscal balance. We never had debt. You can see in 2000 you had domestic debt was 7% of the GDP. Actually, we have 23% of the GDP, one of the lowest in Europe. And we didn't spend money for COVID. There was no packages, nothing at all, because we know that we are currency board. We cannot do this. Just we counted for European packages. And finally, which is very important, that we have a huge regulation on credit, let's say, evolution, because we have reserve requirement, we have different kinds of buffer, and Bulgaria is a member of banking union without being member of the Eurozone. 60% of Bulgarian banks now are supervised by the banking union in let's say, Europe. And finally, I can show you the picture, the real exchange rate. I'm not sure, because I know that the calculation of this, the calculation of real exchange rate could be different depending of the basket, depending of the basic year, etc., etc., etc. But we don't have such kind of let's say real appreciation, like in Chile or in some different country that have that had a fixed exchange rate. And finally. So I already stressed that we have a very huge...
But up is appreciation.
Yes, appreciation. So we have all these buffers, so have this strong public finance. But last year we started to raise salaries, and all this problem probably in the future is it's not very beneficial for the currency board. So the solution is the last side. This is the future. The last side, the solution is either we keep the currency board, but we don't need supportive institution from the, let's say, inside. We need stable political situation. And the second option, which was already speak about this today, Professor Karamer, that we need to join the Eurozone. We have now the negotiation, and next year probably we'll join the Eurozone, depending of the performance on the inflation criteria, which we'll say in a few, let's say, days. But we are already working on the technical aspect of the changeover, about the banknote, how to distribute, how the banknote could be put in circulation, etc., etc. So I think that Bulgaria will join the Eurozone. Whether it's good or not, this is a different question, but it's better to be in a bigger zone, because, as we know, the currency board could stay, but who knows what will happen in few, let's say, years. So this is my presentation. Strong fiscal balance, and full confidence of the currency board as the, let's say, only one institution that the people believe. If we have a referendum of currency board, they will be voted for currency board 100 of the people.
Thank you very much for your contributions. And we close the initial remarks with Georgi. Please.
Thank you very much. Coming from the Central Bank of Hungary, let me welcome you all to this afternoon session. I am not going to talk about the hyperinflation in Hungary in 45, 46, because that has been talked about a lot. But I would like to draw the attention to an experience which is very interesting, in my view. And I'm focusing on those former communist countries who became a member of the EU. The Baltic countries, V4, Slovenia, Romania, and Bulgaria. All these countries have something in common. They used to have a Soviet type economic management. And then suddenly they opened the management. They opened their markets. All of them experienced high rates of inflation. 20, 40, 50, we just heard that somebody was even over 100%. And secondly, they had a policy choice to make, which was choosing the exchange rate. Different exchange rates. Currency board, crawling peg, pre-announced crawling peg, free float, peg, managed peg, and even those that changed over time, okay? Now, what is very interesting, though, is that it's very remarkable that by 2005, prior to the great financial crisis, all these countries brought down the inflation to 2 to 3%. 2 to 3%. What's the conclusion? Fiscal policy was not all the time supportive. Many times they were not supportive. Many, many times. But the central banks kept their credibility. They tried to bring down the rate of inflation. If fiscal policy didn't behave, then they increased interest rates. That was sometimes created a lot of problem between the government and the central banks in many of these countries. Yet, inflation came down. Conclusion, central bank independence, that strengthens the credibility. That's my interpretation of that experience. Now, it has an interesting wrinkle to that. If central banks are all credible and all independent and credible, there is and these central bankers meet, and I'm not just talking now about those 10 countries that I'm done, but the major central banks also. There is a phenomenon that I would call groupthink. People that always meet each other, they always talk about they see the world the same way. One example of it is, in 21-22, inflation is transitory. Inflation is transitory. I had discussion at the IMF, at the ECB. It's transitory. Philip Lane told me it's transitory. Gita Gopinath told me it's transitory. So I was telling them, listen, there was a huge increase in the balance sheets of central banks, okay? Just a few examples. Between 2007 and 2021, Fed from 6 to 36% of GDP. Bank of England from 7 to 52%. ECB from 16 to 67%. Bank of Japan for 22 to 134%. Now I am, this is my last word, I am what I think that Henry Wallach, former Fed governor, said, monetary policy, inflation is a monetary phenomenon, then shooting is a ballistic phenomenon. Thank you very much.
Thank you, Georgi. I think we have a lot of interesting subjects to talk about. So what I heard out of the discussion are the importance of currency boards and some sort of pegs, and what external measure do you use. We heard about indexation, so what mistake that could be. We heard about institutionalized memory, that people forget faster than they could write down. We heard about the importance of the independence of central banks to create credibility, the necessity of the coordination of fiscal and monetary policy, which will become even more important. And Georgi just mentioned the incredible increase of the balance sheet size of central banks, which we experienced over the last years and which still at a relatively high level. They haven't come down. So this is probably an area that we should discuss. But before I use my icebreaker question, so I would like to ask you whether there anybody who wants to do that on behalf. Harald, please.
I wondered after Mr. Tsapari's remark about the convergence, the remarkable convergence in terms of inflation performance in the 2000s, and it is indeed a remarkable phenomenon. And it takes place under very different kind of policy regimes and setups. And so there are a number of different experiences on the panel with monetary policy committees or monetary policy councils. And I wanted to ask you whether you had any reflection on the design of the Monetary Policy Committee or Council. I mean, in particular, it strikes me that the UK, the MPC was really devised by the Labour government in 1997 as a way of controlling an overpowerful governor of the central bank, because the MPC was appointed by the government, and so it was a way of reining in Eddie George. And I think you had exactly the same experience in Poland, that Mrs. Gronkiewicz-Waltz was a controversial person, and the parliament and the parties wanted to control her, and so they went for a monetary policy council. Is there some kind of reflection on the way in which MPCs interact with the policy formation that you would like to make?
I suggest that Gerhard takes that question first, then we go to Charles, and then we see how it goes.
Yes, of course, the policy regimes matter. Not only did the policy regimes change, are very different, but the economies, the size of the economy, the structure of everything. There was a recent article by Alan Posen, you read it, who showed that Bank of Canada, Bank of the United States, the Fed, and who was it? Bank of Japan, I think, they had all very different different economies, different policy changes, and yet they had the exact same path of monetary policy, low inflation, etc. And he also says that he thinks that it's the credibility of the central banks. And I'm fairly sure that that's the case. Without that, you cannot anchor expectations. Now, I'm not sure whether it will last forever. That we don't know. But so for the time being, this is the experience, and I hope will remain that. Thank you.
I have to say, I slightly disagree. The reason I slightly disagree is that after the great financial crisis, we had about 10 years in which inflation went below target in most advanced economies, and the central banks found it very hard to bring it back, although they did their utmost in some very odd instruments like massive QE, which raised the balance sheet, which we've just heard about. The implication that I draw from that is that the world was extraordinarily disinflationary during this period, and that it was nothing to do with the credibility of the central bank. What it was to do with was the inclusion of China and your countries in Eastern Europe into the world's trading system that provided a huge increase in relatively well-organized, available labor supply. The labor supply just absolutely exploded during these years, and inevitably there was very low inflation. And I think that it's actually quite dangerous for central banks to believe that a sort of combination of independence and credibility will achieve results when the world becomes much more inflationary, as I think it will. I think the future is going to be a great deal much more difficult for central banks than it has been in the past. Now, as to Harold's particular question, I don't think the Labour government actually introduced this to limit Eddie George's power. Central bank independence began in New Zealand when they were trying to understand the question of the governance of state-owned enterprises. And central bank was a state-owned enterprise. And so you ask yourself, what is a state-owned enterprise, a central bank? What should it do? And the answer is it should maintain price stability. That was the genesis of central banking independence. It was absolutely nothing to do with trying to curb the power of Eddie George. Nothing at all. And have the various forms of monetary policy, organizations, governing councils, whatever you like, has it made very much difference? The aspect of the Bank of England's Monetary Policy Committee that I most like was the requirement that each individual member was personally responsible for their judgment, and if they disagreed with whatever the majority thought, that person should be prepared to explain why in public before Parliament. And I would add that I think one of the finest aspects of, I think, the way that the British MPC has worked was when Mervyn King was quite happy. He always voted, the governor always votes last in the MPC. So the governor never needs to be on the losing side. Mervyn King was quite prepared to be on the losing side on several occasions. And I thought that was a testimony to the way the system worked.
May I add something to the debate which I haven't heard yet, but which reflects my personal experience as somebody in charge of treasury of a main money center bank in Europe? What I noticed in the corporate sector after the great financial crisis is a big change in corporate behavior with respect to liquidity reserves. So corporations learned that banks will pull credit lines during the great financial crisis, which everybody did. So our bank or my bank did that too. Their response was, we need to have significant cash reserves on our balance sheet to survive. And I think, so I haven't heard anybody quantifying this. I think that's a big factor which led to a deflationary environment. There was so much money swapping around from the corporate sector. It must have had an influence, and I saw it everywhere. I saw corporations calling me, very big corporations said, Hugo, how do you open as a corporation an account with the German Bundesbank, which you can as a corporation, because we want to keep our cash there. So all this happened the first 3-4 years after the great financial crisis as a lesson learned when they saw that their credit lines got pulled. I think that will also has also contributed to the very low interest rate environment at that time. But I'm the moderator. I shouldn't actually monopolize the microphone. Is anybody of the panel members want to comment on the question that just Georgi and Charles?
I would like to come back to what Charles said. So I agree that deflation could be just as bad as inflation, you know? Deflation changes the distribution of income just as much as inflation can change. So these are big issues. These are big issues. But if you look at the history, and I didn't go back very, very long in the history, there were more periods of excessive inflation than there were periods of excessive deflation. So, you know, at least you can argue on that. And also, if deflation lasts for a long time, there is a danger that the next step would be an inflation, an overshooting of the inflation. Because central banks will do everything what they can do, fiscal will be doing everything that they can do, and it can lead to higher inflation. So I agree, deflation is just as bad as inflation, and both depend on the credibility of the policies.
I may use, because we are running out of time, so I want to ask one important question for this panel. The reason why we do this conference is because we, as historians, and as you know, so I was reading history for my university studies. So we believe that institutional memory is important. We have people like Harold James or Pierre who follow the history and document it, and this is a way to institutionalize the knowledge of hyperinflation and how it happened and why and what are the connections. However, we are relatively far away, so we have to do the work 30 to 50 years after events because the archives are not open. What can the central banks do to keep the memory alive in an institutional way? So, because you are the people who, at the end of the day, you have to deal with that problem if it reappears again. What are central banks doing to keep that memory alive, and how you do debating it internally. Maybe can I start with Nikolai first?
Yes. Okay. So what I can say first, we remember there's the first generation, probably the second one. So we remember the inflation in '97. I was at the central bank. The salary was paid every week. I remember many facts. Second, we organized some seminars. Recently, I published, but it's not on Bulgarian hyperinflation, but I published research on the Soviet hyperinflation in the 20s. You can visit the Bulgarian National Bank. The paper is in English. So I try to make some correspondence with the situation in this period, or this, and the theory of MMT, which is not very good accepted let's say in Bulgaria. So now we are going to organize a seminar on this inflation period in the 20s. We didn't have such inflation like in Poland, but we had also our heroes. In any case, it was linked now to debate whether when you join the Eurozone, the inflation will be bigger and not. So it was a good opportunity to make some conferences, etc. But this is recently, this is the last year, you know.
Maybe we can continue with Georgi. You have the privilege of being the advisor to the central bank governor after having been vice governor yourself. So you have an advisory role based on your experience. So what does the Hungarian National Bank do to keep the memory alive?
The memory of the high inflation?
Yeah.
What?
And what you did about it?
Since 1990 or since when?
Since 1990.
But since 1990, we had a view of what we would like to bring down the rate of inflation. We selected first a managed floating, then a pre-announced crawling peg, and every day it was adjusted on the basis of pre-announced. Every month we changed the pre-announced, and what we said was that we will stop the crawling peg when the difference in the price inflation between Germany and between Hungary is what is the difference in productivity. Because if you start out with a lower productivity and go up on a larger productivity, there is the so-called somewhere an effect. So that was the logic. But since I'm not saying that we achieved every time the inflation target, far from that, but we brought down the inflation, just like the other countries. And that's what, for me, is remarkable, that all these countries managed to bring down the rate of inflation. That's not the case in Yugoslavia. I haven't followed very much Yugoslavia, but this is a special case. Yugoslavia was at the war, etc., so they had a different. Turkey is an interesting case, because there is no war in Turkey. Why do they have this inflation?
Charles, you said loudest people can't remember the lessons of history. How did you deal with that in the Bank of England?
I don't know. And one of the saddest aspects, I think, of economics is that economic history has actually been dropped from the requirements of an economics degree. And I think that the separation of economic history from economics is retrograde.
I think that's such a good closing argument that I would like to close here. So that means for us that we do business history and financial history. So we need to engage in a much closer dialogue with the economists who actually do these things. And I think our conference here is kind of a first step in that respect. Thank you very much, the esteemed panel members. Very interesting. Thank you for your contributions.
quick coffee for 15 minutes, and then we reconvene for some fresh ideas about the history of inflation.